1953, a neuroscientist named James Olds was conducting experiments on rat brains at McGill University when he made an accidental discovery that would change our understanding of motivation, addiction, and eventually, though nobody knew it at the time, financial behavior. Olds had implanted an electrode into a rat's brain, intending to stimulate the region associated with fear. He missed. The electrode landed instead in an area that would later be identified as part of the brain's reward circuitry, the nucleus accumbens, and the surrounding structures of what neuroscientists call the mesolimbic dopamine system. When Olds activated the electrode, the rat did not run away in fear. It came back. It pressed a lever to get the stimulation again, and again, and again. In subsequent experiments, rats with electrodes in this region would press the lever thousands of times per hour, ignoring food, ignoring water, ignoring sleep, ignoring everything except the stimulation itself. They would press until they collapsed from exhaustion. Olds had accidentally discovered the brain's wanting system, the dopaminergic circuitry that drives the pursuit of reward. And what he had also discovered, though the implications took decades to fully emerge, was that this system could be hijacked, that it could be activated in ways that disconnected the wanting from any genuine satisfaction of a real need, that the machinery of desire could be made to run on its own, in a loop, without the relief that genuine need satisfaction would provide. This is the foundation of what happens in gambling addiction. And it is, as we will explore in this video, uncomfortably close to what happens in the brains of amateur investors during bull markets, cryptomanias, and the frantic day trading sessions that accompany every major speculative bubble in financial history. The neuroscience of gambling is now well established enough to be taught in introductory psychology courses. What makes gambling neurologically distinctive is not the pleasure of winning. It is the unpredictability of the reward. Dopamine, the neurotransmitter at the center of the wanting system, is released not primarily when you receive a reward, but when you anticipate one. And crucially, the research by Wolfram Schultz at Cambridge University established that dopamine release is maximized not by certain rewards, but by uncertain ones. A reward that comes every time produces a modest dopamine signal. A reward that comes sometimes, unpredictably, produces a dramatically larger one. The brain is, in a very specific neurochemical sense, more excited by the possibility of reward than by its certainty. This is why the slot machine is the most addictive gambling format ever designed. Not because it pays out most generously, it does not, but because it delivers rewards on what behavioral psychologists call a variable ratio schedule. You pull the lever and sometimes nothing happens. You pull again and nothing happens. You pull again and the lights go off and the coins come out. The unpredictability of the reward, not its size or frequency, is what drives the compulsive behavior. The brain, calibrated by evolution to pay special attention to unpredictable resources in an uncertain environment, responds to this schedule with dopamine release that is disproportionate to any rational assessment of the expected value of the activity. This is not a design accident. The modern slot machine was engineered through decades of iterative refinement to maximize exactly this neurological response. It is, in the most literal sense, a dopamine extraction device. Now here is where the story becomes directly relevant to anyone who participates in financial markets. The variable ratio reward schedule that makes slot machines addictive is structurally identical to the reward schedule of speculative financial trading. A stock price goes up sometimes and down sometimes in patterns that are, for the amateur investor, effectively unpredictable. Checking a portfolio produces, sometimes, the reward of seeing green numbers and rising values. Sometimes it produces the aversive stimulus of red numbers and falling values. Sometimes it produces nothing remarkable at all. This variable, unpredictable pattern of reward and non-reward activates the same dopaminergic circuitry that the slot machine activates. The brain does not distinguish between the lever and the portfolio app. Both are delivering variable ratio reinforcement to the same ancient reward system. The consequences of this neurological parallel have been documented extensively in the behavioral finance literature. Research by Brad Barber and Terence O'Dean at the University of California, probably the most cited researchers in the field of investor behavior, analyzed the trading records of tens of thousands of retail investors over a period of years and found a consistent and devastating pattern. The more frequently investors traded, the worse their returns. Investors who traded most actively underperformed the market by approximately 6 percentage points per year after transaction costs. Investors who barely traded at all outperformed the active traders by a substantial margin, simply by holding their positions and not responding to the dopaminergic pull of the activity. The active traders were not making worse analytical judgments about the specific securities they were buying and selling. They were making too many judgments too frequently, driven by the neurological compulsion to engage with the variable reward system that price movements provide. Every check of the portfolio is a pull of the lever. Every trade is a response to the dopamine signal. The activity itself, the engagement, the uncertainty, the possibility of the reward, is the product being consumed, and the financial returns are, increasingly, beside the point. The parallel between gambling and speculative investing becomes most acute during bubbles. The periodic episodes of collective financial mania that have recurred throughout financial history with remarkable regularity and remarkably consistent psychological profiles. The Dutch tulip mania of the 1630s, the South Sea bubble of 1720, the railway mania of the 1840s, the dot-com bubble of the late 1990s, the housing bubble of the mid-2000s, the cryptocurrency manias of 2017 and 2021. Each of these episodes has been analyzed extensively by economic historians and behavioral economists, and the psychological profile that emerges across all of them is consistent enough to be diagnostic. The early phase of a bubble is driven by genuine uncertainty. Nobody knows whether the new technology, the new asset class, the new financial instrument is going to transform the world or amount to nothing. Prices rise. Early investors make extraordinary returns. These returns attract attention. More investors enter. Prices rise faster. The rising prices themselves become the evidence that the investment is sound, a phenomenon that economist Robert Shiller calls narrative economics, the way that compelling financial stories take on a life of their own and drive behavior independently of the underlying fundamentals. As the bubble inflates, the neurological environment for participants becomes increasingly similar to a casino. Prices are moving dramatically. Fortunes are being made visibly and rapidly. The unpredictability of daily price movements generates continuous dopaminergic stimulation. The social environment, friends making money, media coverage generating FOMO, online communities celebrating gains, adds a social reward layer on top of the financial one. The speculative activity begins to feel not just financially rewarding, but intrinsically enjoyable. People start spending more time on it, checking prices more frequently, making more trades, talking about their positions more. The activity has become its own reward, independent of the financial outcome. And then the bubble bursts. And in the aftermath, the behavioral pattern is indistinguishable from what happens when a gambler's luck runs out. Denial, the market will come back. This is just a correction. Continued engagement, doubling down on losing positions to try to recover. The sunk cost fallacy operating with full force. I have already lost this much, I cannot sell now. Escalating risk-taking as the losses mount and the desperation to recover grows. And eventually, for some participants, the full profile of problem gambling, financial devastation, damaged relationships, secrecy about losses, continued participation despite knowing intellectually that the rational course is to stop. The neuroimaging evidence on this parallel is now direct, not just inferential. Studies that have scanned the brains of both problem gamblers and investors during financial decision-making tasks have found overlapping patterns of activation in the reward circuitry, the prefrontal cortex, and the insula, the brain region most associated with the anticipation of loss. The brain states produced by watching a stock price move are, at the neurological level, structurally similar to the brain states produced by watching a roulette wheel spin. The contexts are different. The social valuation is different. One is considered respectable financial behavior. The other is considered a vice. But the neurological machinery being engaged is the same. This does not mean that investing is gambling. It is not. The expected value of long-term, diversified, low-frequency investing in productive assets is positive and well-documented. It is one of the most reliable wealth-building strategies available. The expected value of gambling is negative by design. The distinction is important. But the distinction that matters for financial behavior is not between investing and gambling as categories. It is between the specific behaviors that engage the reward system in a way that produces compulsive, counterproductive activity, frequent trading, speculative position-taking, attention-seeking financial decisions, and the behaviors that do not. The investor who checks their portfolio once a quarter, makes infrequent and deliberate allocation decisions, and holds diversified positions through market volatility is using the same financial instruments as the investor who checks prices 30 times a day, trades impulsively on every significant market move, and holds concentrated speculative positions in high-volatility assets. The financial instruments are the same. The neurological engagement with them is completely different. Understanding the gambling brain mechanism is practically important for anyone who participates in financial markets, because the mechanisms that make gambling addictive are present in financial markets and are specifically exploited by the design of modern financial apps, trading platforms, and the social media ecosystem around investing. The real-time price displays, the gamified interfaces with streaks and achievements, the push notifications about price movements, the social communities celebrating wins, the influencer culture around speculative assets. All of these design elements are not neutral features. They are, whether intentionally or emergently, environments that engage the variable ratio reward system and make the compulsive, high-frequency engagement pattern more likely. The practical response to this is not to avoid financial markets. It is to design your relationship with them in a way that minimizes the activation of the reward circuitry and maximizes the engagement of the deliberate, analytical decision-making system. Fewer portfolio checks, automated contributions rather than active allocation decisions, longer time horizons, deliberate constraints on the frequency of trading, and, perhaps most importantly, an honest assessment of whether the financial activity you are engaged in is being driven by a considered analysis of expected returns or by the neurological pull of the activity itself. The question is simple, and the honest answer is sometimes uncomfortable. Are you investing or are you playing?